Hello and welcome to Pro Trader Strategies Market Commentary for January the 31st. It's a Thursday. My name's Eric Wilkinson and jury duty is over. Some of you may recognize me as the Wolfman from CNBC, Fox Business, or even the Wall Street Journal for my commentary on everything from economic to geopolitical and market analysis. Please keep in mind that everything that we talk about in these market commentaries is not a solicitation to buy or sell any of these securities or strategies. At the end of the day, though, I am here to teach you some different strategies that you can then implement into your portfolios, but please do that in your own way. Also, remember, past performance of any trading system or methodology is not necessarily indicative of future results. All right, having that out of the way, let's get it on with some economic data across the pond. One thing to note, yesterday we did get crude oil inventories. It did increase by, I think it was 0.3 million barrels. Let me just double check that. I had that memorized, I thought. But in crude oil, we came in at 0.9 million barrels, expected to be a build of 3 million barrels. Remember last month we got that build that was way over than expected, 8 million barrel build. No revisions there. We're expecting a build of 3 million barrels. Only got 0.9 million barrel build, or close to a million barrel build. So 2 million barrel build under what was expected. So light. That could cause crude oil to start moving higher. I think some of that pricing is already in there. It wasn't that big of a miss. It was a miss nonetheless, but I think crude oil is still going to start creeping a little bit higher still. Then we go over and talk about the flash estimates across the pond. And we got German retail. Let's talk about German retail sales first. Came in at 0.9%, or 0.9%, expected to be a negative 0.9%. And then we got the flash estimates over there across the pond also for the European region. And French consumer sentiment came in at negative 1.5%, expected to be a negative 0.3%, or consumer spending, that's French consumer spending, light on the spending, more than expected there. And then, where is this? Sorry, you guys. Spanish flash GDP came in at 0.7%, expected to be 0.6%. Spanish flash CPI came in at 1%, expected to be 1.1%, so just a slight miss there. We talked about the German retail sales coming in at negative 1.3%, expected to be a negative 0.3%. Let's move back over here to the United States. Here we got our unemployment cost index came in at 0.7%, lower than the expected 0.8%. We got unemployment claims really jumping, coming in at 225,000. Chicago PMI missed, lowest reading since January of 2018, came in at 56.7, expected to be 61.5. New home sales crushed it. Now, we saw some of these home sales earlier on not making it, not really making the cut here. And my speculation was that increased interest rates was going to kind of slow down this housing buying spree, if you will, because when interest rates are higher, you can afford less of a home. Well, that isn't really showing up in the new home sales because that came in at 657,000, expected to be 569,000, and they revised last month's number up by almost 20,000 as well. So big moves in the housing. New home sales, just the new, not the existing, but the new home sales really doing well. I guess nobody wants to buy a used home. And then we go on to natural gas storages coming in at a drawdown of 170 billion cubic feet, expected to be 191 billion cubic feet. And that's about it for the economic data today so far. Anyway, we got some later stuff coming out of Japan and China. Oh, one thing I did want to note about yesterday on China's manufacturing PMI came in at 49.5. It was expected to be 49.5 also, but just keep in mind that number is below 50. And when we get these PMI readings below 50, that shows contraction in the overall economy. We got the non-manufacturing PMI for China, which is the service sector, came in at 54.7, expected to be 53.9, but they are really... their economy really relies on the manufacturing sector, and that going into recessionary is not very good. Or it's not a recession, but it's a recessionary reading once it goes below. You have to have 3 of them below it for it to be considered a recession, really. All right, so let's talk about the E-mini S&Ps. Yesterday I was saying if we get that late day rally, I think we were down here, late day rally shows strength into the end of the day. That is a very bullish sign. We will, I don't know why I'm throwing up E-mini S&Ps here right now, but you can see with the E-mini S&Ps, the market just completely unabated almost to the upside into the end of the day where the weak hand started to cover going into the close. Overnight inventory pretty flat, maybe getting a little bit negative as some of those longs still continue to cover overnight. But into today's session, we see that we got a big move higher. I was expecting off of that Chicago PMI number that we would see a little bit more weakness actually in the equities and maybe kind of curl back down. But just the opposite effect here. The market really starting to spike, maybe because that is a more consistent outlook with lower interest rates. You know, one of the things is we did that the FOMC yesterday, and they came out with not increasing interest rates. Be honest, I haven't had enough time to really dig into what they said to see if that part of what they said was part of that catalyst. I was at jury duty yesterday during that whole move, so I need to do some research to figure it out. And we didn't get back till very late last night because we did not want to go back today. We wanted to finish it up. So I haven't had a whole lot of time outside of that to do any market research, really. Sorry about that. All right, so let's talk about the E-mini S&Ps. We'll go a little out of order here. I'll talk about the S&Ps first. And as you can see yesterday with the move, we were able to get above these 2 Fibonacci levels that we found as overhead resistance recently. As you can see the last couple of weeks, those were acting as resistance. Now we've gotten above that. And that was a key move yesterday to get above and settle above those Fibonacci levels I've been talking about, because now it gives a little bit more ease to allow this market to rally up to the point of control, maybe settle down there, or just start bouncing between these 2 Fibonaccis and start really filling in this low volume area to create a nice big node here, because that's what we have a tendency to see over the long term, is that we fill in some of these low node areas around 2 larger nodes. We have a tendency to fill those in. We could see that happening with the E-mini S&Ps up on the day and not really looking to break below that support level now. It will act as a support as it acted as resistance in the past. All right, now let's look at the NASDAQ. Again, NASDAQ did the same similar situation where we saw it rally and get back above these 2 Fibonacci levels. That is a nice win for the bulls, and we've gone up to the point of control. This is where we should start seeing this market start to settle down, maybe even bouncing again between these 2 Fibonacci levels for at least the better part of going into next week, I think. Dow Jones Industrial Average, it pierced above yesterday the Fibonacci extension, the 23 Fibonacci extension. It was never really an opportunity to test it throughout the day. It was really just unabated to the upside, as we saw. Today, we're seeing a little bit of that covering from the long, some of those weak hands. As you can see, the Dow Jones is down on the day, but it was up really big yesterday, comparatively speaking to the rest of the broader market. So Dow Jones really making a big move. But now that the tech's starting to pick up steam, I think that you're going to see some of these rotations out of the blue chips and into some of these more higher risk stocks, maybe like the NASDAQ, if we continue to start looking like it is turning into a bullish pattern or a bullish trend here. And then the VIX obviously coming off with the broader markets really kind of rallying. I mean, obviously the Dow is down on the day, but it's not going to affect the VIX if the rest of the equities are higher on the day. So VIX is coming off just a little bit. And then we can look at crude oil inventories. Despite the fact that we saw that big build from last time, it wasn't as much of a build this time. So we're seeing crude oil start to rally. Like, remember, we were expecting a 3 million barrel build. We only got about a 1 million barrel build, so 2 million barrels shy of what was expected. That means that demand isn't where the analysts were expecting it, and we would expect this to kind of come off a little bit. We're seeing this continue to move higher, maybe because of the incredible amount of oil that we have out there right now. That could be part of it. I think that there's an incredible amount. All of these scenario should really make crude oil come off. Some of the sanctions against Venezuela are obviously trumping that build, if you will. But we are seeing crude oil move higher, despite the fact that I think it should go lower. All right, gold moving higher again today. It's gotten above this Fibonacci level as well and has started extending over the value area high. It's starting to get a little overdone. Yes, we do have a very large volume node up here at the 1300s from back at the beginning of the year, but I think the value really is in these lower 1200s. Yes, there has been a lot of price accepted up here in the past, but that was earlier on in the year before we really started seeing the equities rally. I think it's overdone now. It might still continue a little bit to the upside, but I think it's overdone, and I'll talk about a trade that I've added to go along with that market assumption. And then the bonds moving higher today, even though they are not expecting to really raise interest rates anytime soon. Rising interest rates should cause the bonds to start coming over a little bit, coming off a little bit. We are seeing this rally going higher, testing the value area high again. You know, I don't see interest rates rising anymore. Therefore, bonds probably should start tapering off a little bit. If you start thinking that the equity or that the interest rates are going to come out, like they're going to start lowering interest rates, then we should see the bonds start to rally. But I don't see them lowering interest rates anytime soon. So in that, I think that we're a little overdone to the upside here in the bonds. But let's talk about the trade that I've done in relation to that gold. GDX is the gold miners index. It is some of the larger gold miners in there. So they are correlated to the broader markets. As gold goes up, their stock prices go up because their margins go up. That being said, I think gold is overdone to the upside. It's going to roll over. I think that these, although they will lag that a little bit, are still overdone to the upside and will either trade sideways, my market neutral to bearish in gold. So in that, I went in and sold some calls in GDX. I went into the March, sold the 24 calls in there for 31 cents. Haven't done anything with them. I'm also short IWM. That's not working out. If you guys remember, I'm short those 152 calls. It's still, you know, 3 handles away, but the market has moved higher. Volatility has expanded a little bit since I put that trade on, and that's hurting me. I'm still under the assumption that equities are going to kind of hang out here in and around these points of control. So I'll just take that for the theta contraction, and if we can get some volatility come out of there, get out of that trade rather quickly. That's it. Today, though, we are going through with our short call webinar because I'm done, like I said, with that jury duty. I thought we were going to have to go back there again today, but we decided to stay late and make sure that we got everything done while it was still fresh in our heads. And a lot of people had stuff to do today as well. So off of jury duty, good to go. So check out the webinar today, Pro Trader Strategies. I'm going to show you guys, everybody wants to know how to make quick money. I'm going to show you how you figure out when you can make quick money. And I'll teach you all of those rules in today's webinar. Go and check it out at protraderstrategies.com. If you can't take that, take it easy.